Folks, you better get ready. The next 39 days that we have left until 2026 are going to be some of the most extreme, life-changing opportunities. Now, I know what you're thinking, Charlie, on YouTube, everything is a life-changing opportunity. Well, I hate to tell you this, but the volatility this year has been actually life-changing. And what you do right now is going to set yourself up to really, really succeed in 2026. And so that's why it's so important to take these next 39 days to position yourself correctly. How you position over the next 39 days is going to set yourself up to succeed and thrive in 2026. A lot of the stocks that are selling off right now are going to be some of the biggest runners next year. And next year, as the Fed is cutting rates, as the money printer's being turned back on, and as AI CapEx continues to explode, you're going to think, why the hell didn't I buy the dip on these specific deals? So in today's video, we're going to break down, number one, what history says is coming next for the market, the historical data. Number two, why this is an unprecedented opportunity. And number three, the specific stocks that I believe are great buys right now. I'm going to make the case for them category by category. Each of the stocks that we're going to talk about is favorably down from all-time highs, has extreme proof of concept, has a beautiful competitive moat around it, and is something that you can feel good buying now, buying over time, and holding through the volatility. And it's something that I believe that if you look back in 1, 2, 3, 5 years, you're going to be like, wow, I'm so glad I bought that stock. And I'm going to put all the timestamps down below, so make sure to check those if you do want to skip around a bit, but I highly recommend that you watch the entirety of this video because, again, you want to set yourself up for success next year. And as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Okay, so for starters, quick plug. We always save our biggest sale of the year for Black Friday, and this year is no different. If you'd like to get $100 off our annual Discord membership, make sure to do so with that first link down below. Okay, so let's start. So as you know, we've been in a choppy November, a chop-vember, so to speak, and it's been an especially aggressive month for AI and tech names, which if you're a growth stock investor, I mean, quite frankly, it's felt like we're on the Titanic. But don't worry, the violins haven't started playing. So what is the reason that markets have been so choppy this month? For starters, the Fed's December rate cut uncertainty. Oh, we're going to cut it. No, we won't. Oh, we're going to cut it. This member says we might cut it. This member says, no way, we're going to cut it. That kind of uncertainty back and forth has freaked markets out because they priced in a cut. And now that the December cut is being debated, people are like, oh, we better start selling. The market's also down because of a much needed valuation breath and a much needed reset of multiples. Markets are down because of data fog on employment and inflation. The White House has postponed a lot of this data and maybe it's never going to come out at all. There's been massive crypto deleveraging based on BTC breaking key support levels. And there's of course also short seller media campaigns popping up everywhere, freaking people out of their positions. It's a very great thing to have regular dips, regular tests of valuation, and to have convictions tested. It's a great thing to shake out weak hands. This is actually a telltale sign that we're in a healthier market, not an unhealthy market that just goes straight up and then has to go down 80%, killing everybody and causing a financial crisis because of the levels of margin that would entail. But instead of the financial media coming out and saying, hey, markets have always historically needed time to breathe and sell-offs are healthy resets and are good for stability and opportunities long term, all I see them say is endless fear-mongering. You must sell now. You're an idiot if you don't sell now. Sell, sell, sell. You are an embarrassment to your ancestors. You are a dishonor to your family if you're buying the dip right now, if you're continuing to hold positions, because bubble. And a lot of the folks that are fear-mongering right now are preaching 100% conviction that stocks must go down, despite the fact that even in the previous bubble cycles that we've had throughout history, a lot of times you've had like 7 or 8 massive dips before the bubble actually popped. And I find it funny how folks that are endlessly fear-mongering over a crash are considered heroes or considered geniuses. Take a look at the famous Michael Burry, for example. No hate or anything like that, but just think about this. Michael Burry famously came out in January of 2023 and he said, sell. And when he posted that, he was applauded as the great protector of retail money, the defender of the everyman. If you didn't listen to Burry, I mean, you weren't listening to the big short guy. Since then, the S&P 500 is up around 60%. The tech-heavy triple Q index is up just under 100%. And even if markets never go back to the original levels that he said sell at, well, eventually we're going to get a crash. And you know what the media is going to say? They're going to say, look, Burry was right again. And that message will motivate yet another generation of people to be fearful of the markets and to stay all cash, where the government will continue to destroy their purchasing power. If I showed you two charts, chart A and chart B, which would you rather have your hard-earned savings in? Chart A, which has gone down 53% in the last 30 years, or chart B, which has gone up around 1,399% in the same 30-year period? Well, chart A is the value of cash. Chart B is the S&P 500. It might be a shock to you, but most people choose chart A. They decide to give up their returns because they're fearful of any kind of volatility. A lot of people would rather take a guaranteed downtrend than an overall uptrend that just happens to have some spooky McSpooky unexpected short-term pushbacks. Again, spooky, unexpected short-term downtrends are somehow way, way scarier than a guaranteed long-term downtrend. Give me a break. That makes no sense. Despite all the fear-mongering, there's a study that went through all of the years from 1937 to 2023, and they found that 73% of those years were positive years. 73%. That's nearly 3/4 of the years. That means the vast, vast majority of time markets are going up, but because, God forbid, you got to pay a little bit for that uptrend with some volatility, well, people are like, yeah, meh, no stocks for me, bro. And I'm just using the indices as an example, but obviously when it comes to individual stocks, you get even more aggressive volatility and more aggressive potential for outperformance. So again, remember, volatility is the price you pay for the potential for massive outperformance. And so if you're somebody that's reading all these fear-mongering articles and they're saying markets will crash, you have to go all cash. Well, again, cash is already crashing. It's been crashing since they came out with it. And by many stretches of the imagination, it's hard to argue that the stock market does not have some of the biggest wealth creating opportunities coming in the next few years, let alone what has already happened the last 100 years of the stock market's existence. Okay, but Charlie, wait a second. What if we end up accidentally buying at the top? I mean, Charlie, look, the dot-com bubble, if you bought the very, very top, it took you until 2014 to break even. And we're assuming that you must have bought the very top and never bought any of the dips or bought anything before that, and you only bought the index. Well, still, this is an important history lesson, and it's why we preach buying good assets over time slowly and buying even more aggressively when you're down at really good deal territories and starting to trim when you're at all-time highs, when you're starting to see valuations be a little bit too expensive. But still, I think you can minimize this by actually questioning valuations at every point. So let's compare the dot-com bubble highs to today's levels. Dot-com bubble highs, you have the main leader, which is Cisco. It was at a PE ratio of 472x earnings. We were in an interest rate hiking cycle. The USD value at that time was increasing. That means that there were less dollars chasing overpriced assets. And then it was driven by companies with high expectations and low sales and low profits. What about now, November 2025? Well, the main leader of today's cycle is NVIDIA, and the forward PE ratio of that is 24x earnings. We're right now in an interest rate cutting cycle. The USD has been crashing and the printers are turning on, which means that there's more dollars chasing assets. And this market condition is driven by companies with high expectations, yes, but also high sales and increasingly large profits. Are there some examples of smaller companies that have almost no connection to the overall market that are very, very overvalued and are probably going to go down like 99%? Sure. But when you're looking at the core of the market, a lot of the companies that have run and have accounted for most of the growth of the market, well, they have sales to back those prices. Now, that being said, look, at any point you could have a black swan event. At any point, stocks can go down. At any point, you could have Trump or the Fed or whoever pivot massively, and then all of a sudden, your portfolio is down 20%. But I actually welcome those opportunities because I'm not in this game for 2 weeks. I'm not in this game for 3 months. I'm in this game for years, and I want to play it so that I can build over the next 2, 3, 5, 10 years. But Charlie, what if the dip keeps dipping? What if my family calls me a dipshit? Nonetheless, it's all about buying conviction and understanding the bigger picture. So anyways, what is the overall philosophy that we preach? Well, it's super simple, and if you're in the Discord, you see this every day, but this is the core bread and butter strategy. The first and foremost focus is to buy good assets at good prices. Buy dips in high conviction stocks, hold, and sell/trim when the value is realized. Continue to hold if the company continues earning your conviction. And then there's momentum riding, which is a secondary focus. Buying momentum stocks with rapid business model growth, ride the momentum, set stop losses for 15 to 20% down, and lock in profit/cut losses quickly. And then you have our option strategy, and the goal of that is to accelerate momentum on high conviction stocks and hedge downturns and geopolitical events. Now, I always preach a strong foundation of good assets at good prices because I believe over the long run, that's going to be one of the biggest foundational building blocks of wealth. However, there's also a lot of value in momentum riding and options to potentially accelerate your overall account growth. And that's why we preach this very concrete strategy and philosophy. And I think right now it's so important to pay attention to that. Okay, great. So next, Charlie, why are the next 39 days so important? Why is it so important to position now over these next 39 days for a successful 2026? Well, there's a lot of reasons to be optimistic for 2026, and I think that all of these things are going to bail out dips at every single point this year. I think there's going to be tons of corrections, tons of massive dips, tons of people that say, I'll never be in the market again, people that capitulate at bottoms that only see next week the stocks going back up. I think that's going to be a trend next year. But overall, there's a lot of tailwinds. So the reasons to be optimistic for 2026. AI CapEx commitments. Hyperscalers and governments have committed $1 trillion plus in spend. I think it's going to be actually multiples of that. And then more rate cuts incoming. We're in an easing cycle that's going to continue throughout 2026. Number 3, President Trump gets to pick new Fed leadership in May, which is a major tone shift from Powell's slowly ease to Trump's wanting to stimulate. Then there's the midterm cycle liquidity boost. Election year dynamics tend to favor credit easing. Trump will be even more aggressive at pushing this issue with his new Fed appointee. And then there's multiples expanding as rates get cut and liquidity increases. People are willing to pay more for the same earnings/revenue. When rates are getting cut, that's what happens. And then you have President Trump wanting to send tariff checks and other forms of stimulus, which could cause massive melt-ups even further. And then you have $7 trillion plus in sideline cash that is going to largely be motivated into the market. I would say probably around 25% of that could potentially end up going into the market as rates get cut next year and more in the coming years. And then there's the most relevant companies right now. They're beating on earnings. A lot of them beat and they're raising expectations. Number 9, there's a lot of backlogs at the most hot AI companies and they're quite substantial despite the fear mongering. Then of course, number 10, the USD value is melting, aka more dollars are chasing the same amount of stock. So with that in mind, what are the top deals right now? Well, because markets are so choppy right now, you definitely want to double down on focusing on companies that have real revenue, real profit visibility, real margins, and real competitive moats. The best stocks to buy on a dip right now are stocks where the valuation might have reset, but the thesis hasn't broken. A lot of people think when a stock has gone down, that means, okay, the thesis is broken, it's a scam company. That's not the case. That's not how it works. So what are some of these ideas? Well, I want to start with AI infrastructure supply chain plays. So why do we like these? Well, these companies sell the picks and shovels powering AI build out, optical interconnects, substrates, chip packaging, server components, networking gear, accelerators, and integration. A lot of these we've covered extensively here on the channel. Right now, we're in a massive multi-year hyperscaler CapEx cycle. When you're talking about power, cooling, grid supply, this is driving very, very urgent spend, so this spend isn't going away anytime soon. And these names often trade at discounts versus GPUs despite equally strong demand visibility. And you could argue that these are the true arms dealers with diversified customer bases. Some of the names include NBIS, APLD, IREN, Wolf, ANET, AMAT, LRCX, ACN, and of course NVTS. We love NVTS. And then there's the AI software/AI productivity space where you got a lot of real revenue and real profits. Why do we like the sector? Well, you got to understand that software is the highest margin part of the entire AI economy. We love software. The winners in AI application layers get recurring revenue, high gross margins, expanding TAM as LLMs make products better, stickier, and more automated, and zero need to burn billions on GPUs. We love not having to burn billions. And stocks here are down much more than infrastructure despite bigger long-term moats. Great names, Palantir, of course, CRM, which is Salesforce, and then BBAI, BigBear.ai. Now, in terms of industrial automation and robotics, we love this sector. And why is that? Well, because AI plus hardware is right now heading into a massive productivity supercycle. Why? You have AI enabling next-gen robotics, declining cost curves, manufacturing reshoring, warehouse automation, demand exploding, labor shortages, and logistics/manufacturing. And in terms of great names that are down right now and are a good buy, I believe UiPath is an excellent buy. We have a lot of good videos on that on the channel as well. Cloud and cybersecurity defenses, these benefit no matter what the market does. Cybersecurity is a big stinking deal and a lot of spend goes into this category. Now, this is a level where enterprises have to have it. It's a must-have budget item. There's zero discretionary risk. Every incremental LLM in production adds attack surface to attack from. More security spend is needed, and that's why this is such a great sector. These have mission-critical revenue with 80% plus gross margins. Some great names that we've been believers in for many years, like PanW and CRWD, and then some other ones like ZS and FTNT, which we also like. Now, there's healthcare and health tech, and these are companies with real margins, recurring revenue, and data moats. These are insurers and hospital systems pushing aggressively into AI to cut costs, massive recurring subscription revenue, some of these have, and data flywheels, as well as low capital requirements. Some of these names are HIMSS, Oscar, and UNH. Actually, this one doesn't really have low capital requirements, but it has a lot of the other things in the overall trend is going up pretty aggressively for them, for better or worse. Now, when it comes down to semiconductor plays, you're talking real margins, recurring revenue, and real moats, other plays that we've liked for many years that are now trading at a discount again. And semiconductors are the raw horsepower of the entire AI revolution. These companies provide the GPUs, the CPUs, and accelerators powering every AI model, the memory, interconnects, and substrates enabling scale, the networking and power systems needed for data center expansion, irreplaceable supply chain dominance, multi-year visibility from hyperscaler CapEx cycle, which we've talked about ad nauseum, and they have extreme pricing power due to limited global production capacity. Semiconductors are where you get pure, amplified, beautiful, juicy exposure to AI demand, from compute to networking to manufacturing equipment, and when AI spend ramps, which it's doing right now, semis tend to feel it first and the strongest. Great names in the space, of course, NVIDIA, which again, I do believe is still a great buy, and we've been saying that for years because of the actual PE ratios. And then when it comes down to AMD, and then AMD, AVGO, SMCI, MRVL, and of course TSM. Anyways, folks, let us know your favorite plays down below. Make sure to hit that ravishing like button and subscribe. Make sure to take advantage of that $100 off on the annual Discord membership, and I'll see you in the next video.